Wednesday of this week, the Federal Reserve cut rates by a quarter percentage point, bringing their Fed funds rate lower, which should drop mortgage rates, right? Lower, the Federal Reserve drops their Fed funds rate, so mortgage rates should come down. But that's not what happened. The 30-year fixed rate mortgage increased to about 6.75%, which is up almost half a percentage point than this month's low of 6.375%. So why did this happen? If the Federal Reserve is cutting rates, rates should be getting lower, right? Then why are mortgage rates growing? Well, in addition to their rate cut, they also released projections for how many rate cuts they're expecting to do throughout the rest of 2025. And I'm sorry to say, but it was not good news for mortgage rates. The Federal Reserve is now predicting that they will cut fewer times in 2025 than what they previously anticipated. They were expecting their Fed funds rate to be between 3 and maybe 3.5% by the end of 2025. Now they're expecting it to be closer to 3.75%, and the markets are baking that in. They're believing the Fed when they say they're not going to cut as much, and so mortgage rates are higher. We're going to dive deep into exactly why that is. Why are mortgage rates higher based on these projections? What does this mean for the overall housing market for you as a home buyer or a home seller out there? And will mortgage rates start to come down in 2025? Before we get into everything, my name's Liam O'Reilly. I'm a realtor here in Vermont with Jerry Riley Real Estate. If you have any real estate needs, all of my contact information is in the description. Reach out to me directly. I would be happy to help you. So let's get into this first article here where it shows, this is out of the New York Times, and it just shows what happened this past Wednesday. So we see the actual target rate was cut by 25 basis points. This is the dot plot here over on the left side, this black line. We see back in 2020, the Fed funds rate was between 0 and 2.5%, between 0 and 0.25%. And now the target rate is up at between 4.25 and 4.5% after this rate cut. The latest projections expect the Fed funds rate to be at about 3.75, between 3.75 and 4%, according to most FOMC members. Now, these dots that you're seeing, these orange dots on the screen, those represent a member of the FOMC. So each dot is one member. You can see that some members expect the rate to be where it is now at the end of the year, while others expect the rate to be lower, closer to around 3%. When we compare that to where the dot plot was back in September when they released September was the last time they released this projection before Wednesday of this week. And we can see that the majority of FOMC participants were expecting the Fed's funds rate to be much lower by the end of 2025. The majority thought that it was going to be either between 3% and 3.5%, somewhere in that range. And we see this drastic shift of basically a half a percentage point, if we're, or 3/4 of a percentage point, to now between 3.75 and 4%. So those projections are what's driving up mortgage rates. We see that the 10-year Treasury spiked right after the Federal Reserve had this meeting. We see it was trending upwards leading up to the meeting, but then the 18th, we see this big jump after the Federal Reserve released these projections. So why did this happen? Why did mortgage rates jump? Why did the 10-year Treasury jump? We'll just pop over to mortgage rates here. We see East rise 6.75% on the 30-year fixed rate mortgage. Why did this happen? So the Federal Reserve, I'm actually going to hop over to CNBC because they say it perfectly. The Fed funds rate sets what banks charge each other for overnight lending, but also influences a variety of consumer debt, such as auto loans, credit cards, and mortgages. So the Fed funds rate, the actual rate that lowered, that is the rate that banks lend to each other on an overnight basis, right? It's a very secure form of lending. A bank that has excess reserves can lend to a bank that's in need of reserves for one night, and they are going to receive a rate between 4.25% and 4.5% for lending that money to a bank in need. And they're going to make that return right away. It's going to be paid back the next day. Any other lending out there in the economy, so mortgage rates, even the 10-year Treasury, is considered to have more risk than that overnight rate, right? If you're getting paid back on a daily basis and you're making that interest, you're getting all your money back plus interest the next day, that's very low risk for a bank to lend to. So what the Federal Reserve is saying when they release these projections saying that the rate will stay higher for longer, they're telling banks that you will be able to get that return for a longer period of time. So yes, it's very low risk for banks to lend on an overnight basis, but at the same time, it's not guaranteed, right? It's not a fixed rate. The Federal Reserve, even though they typically cut on their meetings, they could really cut whenever they decide to and lower that overnight lending rate to 0, let's say. And so the risk that banks have when keeping excess reserves to lend to other banks isn't that they won't get paid back, it's that their return won't be there in the future. That's why banks and institutions purchase 10-year treasuries, why we saw the 10-year treasury rate drop in December despite no action from the Fed. That's because they were predicting that the Fed funds rate would go down moving into the future, that they wouldn't be able to get that return. So these projections that the Federal Reserve gives, what it's telling these banks is that they will be able to get a solid rate of return for the money that they lend overnight for a longer period of time. And so because of that, less banks, less institutions are willing to put their money into US Treasuries, into mortgage-backed securities. And that's what's causing mortgage rates to increase, right? They influence debts like auto loans, credit cards, and mortgage rates, which is what we really care about on this channel. The Federal Reserve influences mortgage rates, but they influence it by adjusting the overnight rate, which tells banks where they should put their money. And the projection of that overnight rate, the fact that it's projected to be higher for longer moving throughout 2025, is going to encourage banks to keep lending overnight, which means there's less demand for US Treasuries, less demand for mortgage-backed securities. If we think about it like a bidding market, right, where instead of people bidding on paintings and the highest bidder takes home the painting, they're bidding on your mortgages or they're bidding on the 10-year treasury, where previously back in December, banks might say, okay, I'll take on your 30-year fixed rate mortgage for a 6.35% return over the next 30 years. And that works for me. But now when they can get a 4 to 4.25 to 4.5% rate of return overnight, and they're guaranteed to get that for a longer period in 2025, then they're going to demand a higher interest rate, right? Banks might not be willing to lend on that at that 6.3% rate, which is what we're seeing in the mortgage market. Now, what's going to happen as we move throughout 2025? So when we take a look at the longer projections here, we are in CNBC. They're talking about where the FOMC expects the Fed funds rate to be moving into the future, moving in past 2025. And they expect in 2026 and 2027 for the neutral Fed funds rate, which is where they're neither accommodating nor restricting the economy, to be at around 3%. So in other words, what the FOMC is predicting is that rates are going to come down, but they're going to come down much slower than they expected, eventually settling at around 3%. So about 1.5% lower than where we are today, which should bring mortgage rates down another 1.5%, I would think, to around 5% in 2026 or 2027. Now, could we see mortgage rates start to drop quicker in 2025? I think we certainly could. It all depends on what is happening in the economy. Is the economy still strong, or is it showing warning signs? Right now, the indicators that the Federal Reserve tracks are showing strength in the economy, right? The unemployment rate is relatively low. The CPI is at a level that the Federal Reserve finds acceptable, or maybe they want to restrict it a little bit further to bring it down closer to their 2% goal. We see here that month over month CPI in November was at 0.3, and it has been at 0.3 for quite a few months now for core CPI, which is what the Federal Reserve most closely tracks. And we see here unemployment rate at 4.2%, relatively low from a historical standpoint. You can see for most of the 2010s, we had an unemployment rate higher than 4.2%. Even leading up to the great financial crisis, the unemployment rate was higher than it is today. So historically, although the unemployment rate is trending up, we're still relatively low. Now, something I wanted to point out is if we look at what happened in the Great Recession, we see that the unemployment rate was low leading in to 2008. We didn't see it hit 5% until April of 2008. and then it started to skyrocket. So we saw it slowly tick up and then all of a sudden skyrocket moving into 2009 and 2010. So we are seeing a slight trend upwards on the unemployment rate. It'll be interesting to see if we get that skyrocket effect that like we saw back in the great financial crisis. I think if we do, we will, of course, see the Federal Reserve cut their Fed funds rate relatively quickly to help stimulate the overall economy. Now, one last thing that I want to bring up in this video, I know I could talk for about 20 minutes, 30 minutes about this topic, but I just wanted to leave you with this. This is the CPI report. So we see that the November CPI report was at 2.8% year over year, the unadjusted percentage change. When we look at the month over month unadjusted percentage change, we see overall it was down 0.1%. Now, when they seasonally adjust it, which is what the Fed prefers to track, they prefer to track that seasonally adjusted change. It's at 0.3%. Now, this second column here, what I have highlighted, this 1.6%, this is all items besides housing. We can see that we're already below the Fed's 2% goal for all items on average if you remove housing from the equation. Now, on a seasonally adjusted basis, the month over month data was at 0.3, but we see the unadjusted percentage change was at negative 0.2. Now, overall, I personally think that this means we're done fighting inflation, and that's no longer the Fed's goal. If they really wanted to bring housing inflation down, what they should do is lower the Fed funds rate. They should lower the Fed funds rate significantly. This will lower interest rates, and that will spark more investment, more lending into housing, which will bring new construction, more units available, and lower costs overall for home buyers and renters alike. But that's not what they're doing. What they're really trying to do is they're trying to raise the neutral rate, right? They're expecting it to be at 3% because when we do hit the next financial crisis, when we do hit the next recession, the Fed's main tool to deal with that recession is to cut their Fed funds rate. But if the Fed funds rate is at zero and it's sitting low, like we saw during the pandemic, then they don't have the ability to slash the rate to stimulate the economy. So look, I do think the Federal Reserve will adjust their rates moving into the future, and we will see mortgage rates come down eventually. How far out into the future? I don't know. I really did think that it was going to be in 2025, but as we're approaching 2025 here, I'm less certain of that fact. I hope you folks enjoyed this video. I hope you learned something from it. Let me know what you think in the comment section below, and I'll see you in the next video. Thanks for watching.